Did you know that over 50% of Forex trades close before hitting their target? That's right, more than half of traders cut their profits short with their own hands. And here's the twist. In most cases, their analysis was actually correct. The setup was there, the entry was solid, but just before the price reached their take, they bailed. So why do people do this? It is not the strategy, it is this, the mind. Emotions, doubt, stress, fear of losing. It sneaks in when price pulls back just a little bit and it whispers in your ear. Suddenly you're hitting close trade for a tiny gain. And then what happens? Minutes later, the price hits your original target. You were right. You just didn't stick with it. That gut punch feeling, we've all had that. We've been there. But why does this keep on happening? And more importantly, how do you stop this cycle and start holding trades like a pro? Well, that's what we're going to go through in this video. And we'll start with one of the most important ones, the emotions. You're in profit and price is heading the right way, but then with the pullback, you start thinking, what if it reverses? Should I just take what I've got? A better small win than watching it go red. And boom, you're out. You close the trade, you breathe a sigh of relief. But deep down, you know what's really coming. Price climbs back up right to your original target and you're left with nothing but regret and maybe a few dollars in a win. The fix? It starts with your structure. Set your take profit and stop loss before you enter the trade and then leave them alone. If you had a reason to choose that target, stick with it. Don't second guess yourself mid-trade just because the price pulls back a little. Pullbacks, after all, are a part of the process. They're not a sign to panic, they're absolutely normal. And if your plan is solid, just trust it. But of course, many traders don't even have a solid plan. They set targets based on gut feelings or something they saw in a YouTube video, or perhaps a comment. And then when the market moves a little against them, they lose faith, because deep down they know they really never had any belief in the target to begin with, or that they're basically gambling. And that is why reason number 2 is a lack of a tested strategy. If you have ever found yourself halfway through a trade wondering, wait, why did I even pick this target? Then this is probably your problem. You're not trading a system, you're guessing. And guesswork really doesn't have any place in the market, especially as it moves trillions of dollars a day. You just have to know what you're doing. So the solution is backtesting. You take your strategy and test it on historical data. See how often it actually hits targets. How often do those take profits get triggered? And what do the pullbacks look like along the way? Once you have seen your setup perform time and time again, even with temporary reversals, you stop panicking in real trades. Instead, you trade with confidence, not emotion. So you've got the mindset in check now. You've got also a tested plan. But there is one more layer to this, and it is the one that saves you when the market throws a curveball. Reason number 3, no stop loss system or trading stop. So imagine this, your trade is flying, you're in the green, and then bam, news drop. War, inflation, an unexpected Fed announcement, or something like that. And the price flips hard. In seconds, your win evaporates. And actually worse, it turns into a loss. You're frozen. You don't know what to do. Well, here's the harsh truth. The market doesn't care about your target. It doesn't care about your feelings. But you can protect yourself by learning how to lock in profits as the market moves. That is where trailing stop comes in. Instead of closing out in fear, adjust your stop loss as the trade progresses. So let's say the price moves up and forms a higher low. Instead of closing, move your stop loss to that higher low. If the price reverses, you're still out with a win, not a regret. So this is how professionals trade. They don't leave profit on the table, they secure it. But what does all this mean for you? What it means is that if you've been closing trades too early and watching your targets get hit anyway, it is time to fix the 3 things that we talked about. First, get control of your emotions. If you set a target, stick to it. Don't let temporary fear cost your long-term gain. Number 2. Test your strategy. If you cannot trust your systems, you will never hold your trades long enough to win. So backtest. Get the data and trade with confidence instead of just guessing. And third, protect your profits with a plan. If the market does change, and if it does so suddenly, don't let it wipe out your progress. Use trailing stops instead to be ready for any situation. Now I've got a question for you. How many times have you closed a trade too early and watched the market hit your original take profit? What caused it in that case? Was it fear, a lack of planning, or just reacting without thinking? And if you found a trick to stop this, then please drop your trick in the comments below to share it for all of us. This way we can all learn from each other. Because at the end of the day, trading isn't just about reading charts. It's more about mastering yourself, your system, and your strategy. And once you get all of those right, you stop giving profits away. Instead, you start keeping what you earn and truly profiting. So, I hope you've learned a lot from this video, and I hope to see you in the next video. Trade well until then. Have a good one.